Kenya today celebrates Jamhuri Day, the date of Kenya's establishment as a republic, and also Independence Day. So the markets and the banks are closed. Instead of our regular market update, our Nairobi team filed a report on Kenya's stock market in general, which has had a very torrid time in 2011, shedding more than 25% in the past year. That's amid currency weakness, rising inflation and interest rates. They've started to go up, but only late in coming. There's also the question of the Eurozone debt crisis. Let's take a look.
The Nairobi Securities Exchange has been ranked one of the worst performing stock exchanges in Africa this year, touching a fresh new low of 3,070 points in early December. This as the Kenya shilling hit an all-time low of 107 to the US dollar in mid-October, and as inflation rose to the 13th consecutive month to reach a high of 19.72% at the end of last month.
Well, it's been an incredibly difficult year. The NSE so far this year is down 27% and a little bit of change. It is the second worst performing market in Africa, only after Egypt, and we all know the events that have happened in Egypt. Egypt is down about 43%, we're down 27%. And obviously the reasons are not too difficult to find. We had incredible volatility in the shilling. The shilling was the worst performing currency in the world from the beginning of the year until October 11, and then it rose from zero to become a hero. October 11 to today, we've risen about 16 to 17%, and it's one of the world's best performing currencies, but at an enormous cost. They've had to put up interest rates. The interbank rate is above 30%, and this has put pressure on the stock market. And then, of course, we've had this burst of inflation. Just over a year ago, inflation was 3.1%. Everybody thought we'd entered a new normal. We were running at a completely new inflation profile. And then we had this burst where it's gone up every single month for nearly 14 months and is now just shy of 20%.
With foreign investors constituting 60% of all trade on the local bourse, the NSE has not been spared from the Eurozone debt crisis.
There's been a strong flight to safety in money managers in the Eurozone and even in North America and partly in the US, because we realize the investors, foreign investors in the local stock market in Kenya, are huge mutual and hedge funds, and some of them were holding some of this debt in the PIGS countries. Portugal, Ireland, Greece, Spain, and lately Greece. And to them, the natural thing was to hold cash as close as they can, and by extension, it meant investments like equities and mostly in frontier markets like in Kenya. They reduced their allocations, and by extension, the local market has faced less inflows and participation.
Despite the challenges, the NSE saw 3 new listings this year, including TransCentury, British American Insurance, and CFC Insurance Holdings. It also welcomed back Uchumi Supermarkets, which relisted in May after 5 years of suspension.
Every single IPO has been a bust. If you'd put money in Britac, you'd be down over 42% in less than 3 months. And I can't find many places which could decimate your capital as quickly as this IPO has done. TransCentury was an introduction of our listing, so they weren't really selling many shares, and therefore the price has been more stable, but it has also gone down. The return of Uchumi, which came back at a price of 14, but is now below 8. So the trend is your friend, and the trend is saying that the equity markets are very weak. They're unable to sustain a fair value, and I would even argue that in many shares, they are in what I would call a disequilibrium. They're not really reflecting the value of the company. They're reflecting a lack of liquidity and a lack of cash in the markets.
Analysts expect that rising inflation, uncertainty in Europe, and Kenya's presidential election next year will still pose a risk for the bourse in 2012. But they do see some upside, with the market likely to rebound in the second half of next year.